Hey, what's going on everyone? Thanks for checking out this video. My name is Travis from Master the Market, and in this video we're going to talk about support and resistance. We're going to cover the basics of support and resistance, as well as some tips that a lot of new traders don't really know about support and resistance, that a lot of times lead them to use them the entirely wrong way and take a lot of unnecessary losses that hopefully after watching this video you are going to be able to avoid making. So with that being said, let's go ahead and start with the basics. What is support? Support is essentially a price level where a stock historically has a difficult time breaking below due to stronger demand than there is supply. Now, simply put, the stock market moves really because of supply and demand. If there's more demand, meaning that there are more buyers at a certain price than there is supply or sellers, then all of that demand and all of that buying is going to push the price of the stock higher from that certain price level. And really, that's exactly what happens at a level of support. These support levels start to form, and you can see that there often ends up being a very clear level of support as the price starts to bounce from the exact same area over and over and over. And we can look at that as an opportunity to buy low at that support level because, again, it's having a difficult time breaking below. And as the price of the stock then bounces off of that level of support, we can then go ahead and sell high, making a profit on that trade. And really, that is the entire goal of trading in the stock market, whether that's day trading, swing trading, or even long-term investing. We want to buy low and sell high, and support simply offers us an opportunity, in many cases, to buy low before being able to sell high. So if we take this example here with AMD, this is a great opportunity to buy low at this $74 price level. Once we start to see this level of support forming, as the price bounces over it multiple times, we can buy low in this case at about $75. As the price bounces up, we would have an opportunity to sell at $85, making about $10 per share on that trade. Then you can see the stock pulls back to that support level yet again. So we can buy again at that support level, being able to sell higher later on. And once again, it does pull all the way back down to support, so we can buy low and again sell high, repeating this process over and over and over as long as that level of support does stay intact. So you can see already how this really simple method of technical analysis, by looking for these levels of support, is a really great way to take a lot of the guessing out of when you should buy a stock, and of course is going to allow you to start buying low based on strategy and based on the chart itself. Now on the other side of the spectrum from support, we have what is pretty much the polar opposite, and that's going to be resistance. Resistance is simply a price level where a stock historically has a difficult time breaking above due to this time stronger supply than there is demand. So there's more selling and there's more supply at this price level, which is going to inevitably drive the price down from that price level, offering us an opportunity to sell high before the price pulls back down. So we see these price levels forming. We see the stock failing to break above this certain price over and over and over. You can then determine, of course, that that is a level of resistance. And if you are currently in a position, so you bought earlier on, and you're looking for an opportunity to then sell high before the stock reverses to the downside, a level of resistance is a great way to do that. And additionally, another way to take advantage of these resistance levels is to actually go ahead and short sell at resistance. For those of you who may not know, short selling simply allows you to sell high first. So you technically borrow shares from your broker to sell high when you think the price of a stock is going to go down. And then you can later on buy back those shares at a lower cost, returning them to your broker and profiting the difference between where you bought and sold. So you still want to buy low and sell high, but with short selling, you simply sell high first and then ideally buy low later on. Again, these resistance levels can offer us a great opportunity to sell high first and then actually profit from that reversal to the downside. That often does happen after resistance is formed. So to show you a quick example of this in real life, we have the chart for DHR, and we can see that there are a few opportunities here to actually sell into this resistance level that is starting to form just below $250 per share. So had you been in a position in DHR prior to this resistance forming, and you're looking for an opportunity to sell and lock in your profits on the investment, once this resistance level starts to form and you start to see the price is struggling to break above $250 per share on multiple different occurrences, that's going to tell you that some resistance is forming, and it's going to be a good idea to lock in profits on that trade before the stock does start to pull back down. So essentially, the really nice thing about resistance is it takes a lot of the guessing out of when you should sell your stocks, which is something that a lot of new traders struggle with because they often end up getting greedy and they often hold on to stocks for much longer than they should, which leads them to watch their winning trades turn into losing trades. So by selling at these resistance levels, you're hopefully going to be able to prevent yourself from doing just that. Okay, so with all of that being said, this is where things with support and resistance kind of start to get a little interesting because most new traders do actually know what support and resistance are. They know most of what we talked about in the previous few minutes, but they don't necessarily know some of the things that we're going to talk about here in the following few minutes that have to do with stock breakouts and stock breakdowns. So essentially what a breakout is going to be a move above a defined level of resistance, and a breakdown is just going to be a move below a defined level of support. So to take breakouts and breakdowns a step further, once a stock actually breaks below support, that past level of support can then become a level of resistance. And vice versa is also true. A stock that is breaking out above resistance can then pull back to that past resistance level, which can now become a level of support. So to kind of help you visualize what this is going to look like, if we take the diagram here down at the bottom left, you can see that initially we have a level of support that forms on the stock, but eventually the price of the stock does end up breaking down below that support level. And as it bounces back up, you can see that that past support is now becoming a level of resistance. And if we were to flip things around and we had resistance first, once that stock breaks out above that resistance, it can pull back and that past resistance level can then become a level of support. So this is very important to keep in mind because a lot of people will see that a stock is breaking down below support or breaking out above resistance, and they simply remove those lines from their charts because they no longer think that they're very valuable. But even though the price has temporarily broken above or below them, they can of course still be very valuable price levels in the future. Now with that being said, it would be wrong to talk about breakouts and breakdowns without also talking about false breakouts and false breakdowns, which are short-term temporary breaks above resistance or below support before a reversal in the opposite direction. These false breakouts and false breakdowns are really just fake outs to mislead inexperienced traders to panic sell at the bottom of a move or panic buy at the top of a move. So if you're a new trader and you've ever seen a stock breaking out above resistance and you decide that you're going to buy into this momentum and hope that it breaks out and continues to run to the upside, but what happens a lot of times is it comes immediately back down below that resistance level and actually ends up going significantly lower. In that case, what happened is you simply bought into a false breakout. And unfortunately, this is something that causes a lot of new traders to lose a lot of money. And here's an example of what this often looks like in real life. We see that there is a level of support forming at about $48 or $49 per share here on AMD. The stock repeatedly bounces off of that price level. And on this particular day, the stock briefly breaks down below that price level, most likely faking out a lot of new and inexperienced traders before bouncing back up to the upside and actually running up and breaking to new highs. So what happens is a lot of people see this support level. They think that if the stock breaks down below support, it's going to continue to go lower and lower. So they start to panic a bit and they sell their shares at the very bottom of this move before it bounces back up and goes higher. And although it is very good to manage your risk and cut losses, especially if a stock is starting to show some bearish signs, such as breaking down below support, but it's obviously never a good thing to cut losses on a false breakdown by selling at the bottom of the move. So that's kind of where proper risk management is going to come into play. If you happen to have a stop loss, which is an order that is placed to automatically cut your losses on a trade if a stock reaches a certain price, if you have one of those placed below a level of support, because you know that a breakdown below support is a bearish signal and you want to sell your shares and cut your losses if that does happen, it's very important to give your stop loss some wiggle room below that level of support in order to prevent yourself from getting stopped out on a false breakdown. So for example, if there was a stock that had a support level at $10 per share, it's going to be a bad idea to place a stop loss at $9.99 or even $9.98, because in that case, you're not giving yourself any wiggle room for a false breakdown, and you're immediately going to be stopped out if the stock breaks down below that $10 support. So my recommendation is to give yourself anywhere from 1% to sometimes all the way up to 10% below support. And really, this is going to depend on how volatile the stock is that you're trading, and of course, your own personal risk tolerance. Now, as far as volatility goes, if you're trading a stock that trades in very small ranges and there's not a ton of volatility, you can often get away with putting a stop loss anywhere from 1% to 3% below that support level. But if you're trading penny stocks and you're trading these low float pump and dump stocks that have a lot of volatility and they trade in very big ranges on a daily basis, in my opinion, you probably want your stop loss to be anywhere from 5 to 10% below a level of support to avoid yourself from getting stopped out on these false breakdowns. At the end of the day, you have to keep in mind that everybody else that's looking at the chart is also going to be seeing these same support and resistance levels. And the entire goal of other traders and other hedge funds and institutions is to see you lose money in order for them to make money. So if they see the same support level that you're looking at, and they know that there's a good chance a lot of retail traders like you and I are going to have a stop loss placed below that support level, a lot of times what these traders with a ton of money will do is temporarily drive the price of the stock down below that level of support to fake out inexperienced traders before the stock bounces back up and goes higher. So while it is a great idea to have risk management in place and to cut your losses on a trade, you do still want to give yourself some room below support to prevent yourself from being manipulated out of your money. Alright, so that's going to be a wrap for this video. I hope you enjoyed and learned something new about support and resistance. If you did, please make sure to give the video a like and subscribe to the channel so you don't miss out on future videos and future video lessons. And of course, if you're looking for more information about day trading, swing trading, and even long-term investing, all of that can be found at my website, Master the Market, which is going to be the first link down below in the description. But anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading. I'll see you in the next video.